To the financial space now. In a recent note on banks, Motilal Oswal Financial Services say that they expect the fourth quarter earnings to remain steady and net interest margin contractions to ease, while they still remain watchful on credit costs in FY25. To discuss more on this, we are now being joined by Nitin Aggarwal, who's the head of the BFSI Research Institutional Equities at Motilal Oswal Financial Services. Nitin, good morning. Thanks a lot for joining in. What are you penciling in for the quarter when it comes to the banks? The whole host of banks have come out with their business updates. What do you make of them so far?
Yeah, hi, good morning. So business updates, yes. Many of the banks have reported the 4Q business updates, and they have all surprised positively, especially on the deposit growth side. So we are seeing a very strong uptick, and some of the banks even have reported a uptick in the CASA ratio also. So while some of the large banks, they don't come up with this update, but there is a positive read across that we are looking at for the other large private banks also, and which is where the hopes are good that we will see a stronger uptick in deposits, and this will probably support a relatively better loan growth. While we are expecting a systemic loan growth to moderate in FY25, but some of the industry bodies, rating agencies, and the view is like that we are factoring in the numbers is that will be a moderation of 200 odd basis points, which still is good enough and can get supported given the recent uptick in deposit growth that we are looking at.
So Nitin, what is your own estimate of the loan growth for the industry in FY25? And with the strong deposit mobilization, you're saying there could be an upside to that. So what's the number?
Yeah, so as of now, we are around 13.7, 13.8 on the loan growth number. And this compares to 16% loan growth number in FY24. And thereafter, we expect it to inch up to 14, 14.5 in FY26.
What about the recent RBI clampdown on unsecured lending? Is that showing up in the Q4 numbers? Have you seen it? And if you could just give some examples.
Yeah. So overall, there has been a moderation in unsecured loans, and we will likely see banks reporting a sequentially moderate growth in unsecured loans, both the PL and the credit cards. And while banks in their business updates have not really reported the unsecured numbers separately, but that's an area wherein we believe the growth will be more measured versus how it has been in the past. And that will have some bearing on the margins in the coming quarters.
You know, Nitin, in your top picks among the banking space, you have highlighted ICICI Bank, SBI and IndusInd Bank. The one stock that everybody wants to know about on the street is HDFC Bank. The business update was pretty robust. The stock was up 7% last week, which was the best week it had since almost 2022. Is the worst over for HDFC Bank? It may not feature in your pecking order, but then that's what the street may want to know. Is the worst over for HDFC Bank?
I think the worries on HDFC Bank were never to do with the earnings as such. It is more to do with as to how they align themselves with the RBI requirements on CD ratio, how well they can bring the balance sheet health back on the LCR front, wherein we think that post the strong quarter that they have reported, things will move in the right direction. And HDFC Bank, while reporting a very strong deposit growth, have also reported a slight improvement in CASA mix. So that is a very strong number to look at. And while the pace of moderation in CD ratio will be more calibrated, we cannot really prorate the 4Q number because 4Q, first of all, is seasonally a strong quarter. And secondly, a lot of borrowings from HDFC Limited are non-callable. So therefore, bank will want to retire them as they come due for maturity. And which is where the decline in CD ratio is more calibrated, but then the journey to that has already begun. And which is where we think the valuations where HDFC Bank is looks very constructive, and that's one reason why we continue to maintain the stock as a buy.
So Nitin, in Q3, the big concern was the NIM moderation. And of course, the fact that deposits were, quite weak, but you are seeing a pickup, aggression by many banks to mobilize deposits. On NIMs, what are we expecting this time?
So on NIMs, we are looking at a moderation on a sequential basis to continue. That's something that has been going on for a year. But the pace of NIM moderation will moderate. And that's what we have written as the title of the report. And wherein, say, for larger banks like ICICI, we are looking at a single-digit NIM decline in this quarter. So NIMs, therefore, are now looking to stabilize somewhere. We are close to that point. But ultimately, as to how things pan out in FY25 will be a function of as to when and by how much RBI really cut rates. Now, our house views that the rate cycle is getting a little pushed back in terms of the easing cycle, but that is something very critical when you want to form a view as to how the margins will pan out over the next 1 year basis. Or over the near term, I think the NIMs are like closer to bottoming out.
What about PSU Banks, Nitin? SBI does feature as your top pick, but a recent note from a domestic brokerage has said that most of these banks in valuation terms are pricing in the best case scenario, and that this will recede over the next 2-3 years. The tailwinds will recede over the next 2 to 3 years. What side of the camp are you on, Nitin? Are valuations indeed pricing in the best case scenario, or is there still more to come for these state-run lenders?
No, we continue to like SBI, and we have been overall quite positive on the PSU space over the last 2-3 years. And while yes, the valuations have now reached one-time book, but when you look at it in context to how these banks can continue to grow, wherein we are looking at a double-digit loan growth to sustain and ROEs in very healthy to high teens, that is looking sustainable. So which is where you will continue to get CAGR returns with these names. And the cyclicality that has always been there in the past is no longer looking on the horizon. In fact, post the general election results, with continuity likely remaining, these banks can continue to deliver very steady earnings, and which is where we continue to maintain a positive stance on the sector. But within them, yes, we like SBI a lot more than most other banks.
Nitin, today, Bandhan Bank has seen some downgrades post the CEO announcement. Nomura has downgraded it from a buy to a reduce. ICICI Securities saying they're under review from their ad rating. Now, I think you have a neutral rating on Bandhan Bank. How have you viewed, the recent corporate developments, and is there a chance that you would look to downgrade it? You have a neutral view, I believe.
Yes, we have a neutral view, and we downgraded the stock in 2021 at the peak. And so the ongoing developments, the recent one especially, has come in as a surprise, and the stock therefore naturally has reacted on that negatively. And we believe that while from the number standpoint, things are likely to trend better, but given the uncertainty around, and now both the management succession as well as the audit report which is awaited, so both these things will have an overhang on the stock performance. And if there is no fresh negative disappointment, then given how the numbers are likely to pan out, because Bandhan has already addressed a large part of the issues when it comes to asset quality. The SMA book used to be very high double digit, and that has come down to now the low to mid single digits. So there is a considerable redressal of the asset quality issues. And as therefore things move in the right direction and the ROAs and ROEs recover for the bank, it can see some performance. But given the uncertainty in the short term, which is why we continue with the neutral rating for now on Bandhan Bank.
Nitin, pleasure speaking with you this morning. Thank you very much for joining in, and look forward to your insights once the numbers start coming in. Do join us then. We will move on now to the real estate stocks because they are buzzing in trade today. Sonal is here with a complete roundup of all that action. Sonal. Okay, we will get to Sonal in just a bit. We will slip into a break for now, and we have an announcement to share with you. We're launching CNBC TV18's first ever live personal finance webinar, CNBC TV18 Accelerate Personal Finance Handbook with Sonia. She will be joined by 3 well-known experts on Saturday, 11th of May, 9 a.m. onwards. We'll be diving into everything you need to know to master your finances and learn how to grow your wealth, be it insurance, tax saving, managing your portfolio, retirement planning. There's lots to learn, lots to do. Whether you're in your 20s, 30s, or even 40s, this live webinar is for you. We have limited seats, so don't miss your chance to register. Scan the QR code to register or log on to cnbctv18.com, and we'll see you on the 11th of May.